I want Wendy to get the full benefits. That's why I paused it. I'm like, hey, I happen to look at that, so let's get that.
Good thing you caught that.
Jumped on. I'm like, what's going on?
So did you tag me on that, or do I need to?
No,
'Cause
I'm
I
not.
don't have all that. Huh?
He's gonna. You're gonna tag her, right? I can edit it too once he goes in. I'm waiting for this
Okay.
to end. Here, let me stop the.
The following program contains views that are not those of WVTC, iNetworks Communications, their subsidiaries, affiliates, or financial supporters.
Winning victory through Christ, WVTC Allsip Chicago, and iNetworks Communication Station.
Hey, okay, guys, I'm back. We're live. I'm here with the great Wendy Lee, Brian Sewell, the mortgage doctor. Sorry about the confusion there. Here with you every Thursday from 4 to 5. Wendy, I can't see you. And I'm going to have Wendy reintroduce herself in a minute. So one of my good friends, Wendy Lee from Exit Realty. And we are so grateful to be with you and be live with you. One of the things we're going to talk about, well, the purpose of our show is to help everyone that want to build wealth and become homeowners through education, encouragement, empowerment. I believe those 3 E's. Education is getting the right information and understanding, the why and why you should buy a home. The encouragement part is that there's so many distractors and so many things that comes in, and that a lot of times people get pushed away and not able to get opportunity to buy a home just by not having the right information. And then what did I say? Education, encouragement, empowerment. That gives you empowerment to make a good decision. So without further ado, and you guys probably heard this earlier if you haven't, but you just tuned in. I got Wendy Lee here from Exit Realty. Wendy, tell us about your new office, who you are, all that good stuff. Just jump right in and kind of.
All righty. Okay, so I've been in real estate for 20 years, and I own my own real estate office. I've been doing real estate full time for the last 20 years. And I decided to go in and open up one of my own offices to help share the wealth and help grow another part of help the company grow in another part of the city of Chicago. So we are located in Pilsen, Illinois. Pilsen, Chicago, which we are right down the street from Chicago, right down the street from Chicago, South Loop. So we're just minutes away from downtown on the lakefront. Area rich with culture and of course also great food. So we have a lot of historical, or I should say not historical, family foods. We're also down the street from Little Village, so there's Italian food, Chinese food, Mexican food, you name it. So of course Chicago, we earned the name of the best city with the best foods, right?
That's
people who lived in Chicago, moved away to different states, and just lived for the food, right? So we're known for food. So pizza, you name it, right? So we have it all. But ultimately, the reason, my mission, and why I was trying to open up my own office is to share in the opportunity to help other people grow their portfolios with real estate. My mission is that I want that everybody I touch to, whether it be a client, a business partner, or an agent that I work with, and of course an investor client, a buyer seller, right, is not only should we focus on being able to buy one property that is your private personal property, your residence, but we should be able to help you provide you the opportunities to acquire more property that become a portfolio for you to live off of as a passive stream of income. And that's very key. Passive, while you are working actively doing what you also love, that at least another stream of income can come to you passively through investing in real estate. I did my first event yesterday where it was a wisdom, wealth, wine series with women, and I'm showcasing how everyday women can become empowered women. And we had such a great turnout. We had about 50 people, 50 women who just wanted to learn how to help build a college fund for their kids. So here we are helping to create legacies and building generational wealth. And that's what we're all about.
I love that. You just gave a lot of information there. I took some notes. And I applaud you on doing that. You can tell that you're passionate about that, and your purpose is in there. Something you said when we didn't know we weren't live. You said 2022 is what you say? I wrote it down, but I want you just to get that out there. What's your year for? The year of.
Oh, year of more.
Yeah.
So I've coined this year, 2022, the year of more. So I wish that you have more abundance, prosperity, wealth, health, faith, peace, whatever it is. We're here to help you with that, to accomplish whatever that more adjective is, right? Whatever that noun is going to be. What do you want more of, and how can we help you accomplish that? We're not just about trying to help you with real estate. Of course, we're a real estate brokerage, but how can we connect you with partners that if you're trying to get into a business, or if you're trying to get into a financial product, whatever the case is, there are different streams to get into creating financial legacies for you and your family.
I love that. And we're kind of doing the same thing. I think I told you I want to add I want to take 3 people on in the next year. Not 3, but entrepreneurs that want to potentially become loan officers that we can teach in the business and show them, but take one at a time. I only can handle one project at a time, Wendy. so everybody
human. What they say, right? Multitasking sometimes doesn't allow us to multitask.
Yeah, I don't want to set them up to fail, but you got to ultimately have a drive. And I think Wendy, you're doing the same thing with adding agents onto your team, but having that passion and a drive to succeed, and we like to give that back. That's part of it, right? It doesn't help us, sure, but giving back to those that need some help, that need some assistance, need a hand, and then going along and helping them get there. You said the year of more, whether it's prosperity, faith. So many times when we've talked off air about this plenty of times, but as far as like, why do you think it is? And there's probably 2 or 3 different types of home ownership levels, where whether you're a first time buyer getting in, you need to build wealth, whether you're a second time around, or rebounding, or you're moving up your house. And then you talked about the investment, and then we got commercial and all that stuff, which I put that all in the investment bucket. Though, kind of talk about each one, if you don't mind. And we didn't pre-practice this, but just kind of leading on to what you said more. But let's kind of talk about, spend a few minutes on the first time buyer, what that looks like, why you should buy and build wealth, and then give me a little bit about the second move up buyer, how that looks like and why it's a good time to buy. And then let's maybe spend some time on the investment side, whether it's 2-4 unit, or then go into that commercial stuff. So I guess gave you a loaded question there. You got enough time on the show?
And the one thing about it is I'm so passionate about when I talk about it, I tend to go over my slot. So you're gonna have to kind of wrangle me in, right?
All right, let's go first time.
What'd you say, Brian?
Let's go first time first.
First time home buyers. I mean, no time like the present to buy, guys. It is low historical interest rates. And I'm sure people have said, oh, I've heard that for years now. We've had the lowest historical rates, but I truly, and Brian can certainly attest to this, right? We are truly at its historical lowest in time. And we're seeing that. And this is a topic that I'm going to be talking about next week, but ultimately, guys, less is more, or is it more is less, right? So what is that? What do I mean by that? Am I going crazy?
Yeah.
Because right now the interest rates are low, prices, people are like, oh, it's so high. You're listening to what social media is talking about, your friends and family are talking about, our colleagues talking about, oh, it's a crazy market. But the one thing I will say is that you're not going to get the interest rates any lower. I just don't see that. I'm certainly not. Cleo, is that what that was? That lady back in the day can predict the future. I mean, I'm not Cleo, and I can't tell you that it won't go down, right. But just from the trends, it doesn't look like it. In fact, we're trending up, guys. Yeah. Right, we're trending up. So at the end of the day, trending up only means it's going to cost you more for the exact same house. So that exact same house, and Brian, help me out here. If it's that house is $325 now, and the interest rates are this, and it's, let's say, another 0.5 point higher, or even a 1/4 point higher, how much is that monthly payment at $350?
So it's funny you mentioned that. So I would say rates in general have gone up about 0.5 point. So if we think about 325, using that example, right? You're probably looking at about, what was that, 1459? Oh, I'm just kind of keep talking, Wendy. Stop putting me on the spot like that.
I mean, the thing is,
so what has happened in the last, let's say, month, is that or that's probably costing you about another, let's say $60-$80 on a house like that a month. And that may not seem like a lot, but by you delaying things, that cost it's costing you thousands of dollars over the life of the loan. Now, you said something, and I like what you said, get more for less. So even historically, we are dealing with all-time lows, even if you're in the mid threes or low threes, or you can buy down rates, all that stuff. When I first got into business 20 years ago, and I heard people say, 30, 40 years ago, the rates were 18%, but the houses was $50,000. That's different. But if you talk about, couple $100,000 house, costing, 6% or 6.25%, 5.5%, you buying points. I mean, you're still talking about the threes, guys, to buy a house. And over 30 years, I mean, you're not paying 4 times for the house like you used to. You can afford more house than it would be with a rate if a rate went up a whole point. You just will be able to. So if you turn around and say, hey, I'm going to wait, and then you're paying a higher interest rate, that's going to cost you a lot more potentially. It is thousands, not potentially. So you're talking about $100 a month. That might be $1,200 a year. You can save that money and just take it on a lower interest rate and being able to maybe get the house that you want now instead of having to wait. And you're building wealth. The prediction that I've seen from Barry Habib at MBS Highway, and he predicted the crisis, guys. So I stand by him a lot. He predicted the whole thing when no one's seen it coming. Is that the 2008 crisis? To be clear, the thing is, we're expecting the model of values to continue to climb. Maybe not at the pace of, what was it, 14, 15%, whatever it was last year, but we're expecting them to continue to climb. So if you go up conservatively 4 or 5%. You're built. That's how you begin to build wealth.
You got it.
Yeah.
And there are people who bought a year ago, not even a year ago, has found that they're building equity in their home because naturally, with all the demand that is out there, because there's not enough supply to meet the demand, right. So naturally the prices go up, and so it's not. And so let me just clear this piece out. It is not the sellers trying to be greedy, because I hear that all the time, how they're trying to be greedy and they're trying to get these prices, right? But it is ultimately the buyers who are driving the prices. So it's based off of necessity, right? And demand. There are some people who want to be in a home because, again, they don't want to be dealing with being a landlord. I had a client, I think we closed her, I think she's coming on a year, but ultimately she was living in Bronzeville in the city, just by the lakefront, and she lived in a garden apartment, and she was paying, I think, $14.75 with her monthly payment was her rent, in a basement. Okay. And then she decided she wanted to buy a home. And we had to work out some things because there was some high student loan debts and all that. So, but we work things out. So again, this is another topic that, make sure you have Brian check in to talk about like your student loan debt, right? Because that is a big component.
That's been coming up a lot. We should bring that up in a little bit in the next segment.
Yep. So, we definitely want to talk about that. But ultimately, she went from renting a 2-bedroom apartment for $14.75 to owning a whole house with a second level, a basement, a backyard, and a garage, and her monthly payment was only $50 more. But now, get this, you may be paying $50 more, but now you're going to get more money back from Uncle Sam because now you own a home and your home is a tax write-off, right? And if you work from home, which she did work from home a good portion of the year because of COVID, she was a student, a teacher, so she was e-learning, right? So then you can write off certain things, and we would have to probably bring an accountant in there, but ultimately, typically those type of expenses become a percentage of it. I think it's 25% becomes deductible. So now you're going to get even more money back from Uncle Sam. So then now that you own a home, you're saving money. You're paying a little bit more money, but you're going to end up saving money and getting more money back from Uncle Sam because you could not deduct any of those expenses because you rented. Okay. And then now you're paying yourself as a landlord instead of your landlord. You are the landlord. Now, let it be if you bought a multi-unit, which was the next step up, right? That if you stepped up into a multi-unit, now depending on a 2, 3, or 4 unit building, you could be a tenant either helping you pay part of the mortgage, 2 tenants helping you pay the entire mortgage, or 3 tenants helping you pay the mortgage and putting money in your pocket, right? So it just really depends on your specific situation and your needs, because some people doesn't want to live in a building with the rest of their tenants, or they need more space because now they're tired of living in an apartment. There's not enough space. They outgrew themselves and they need a house. I mean, a house with a basement, right? Or a backyard because they want to put their children in a backyard, or dogs need a backyard to play in too, right? So
Right.
have an opportunity to chat with them, and then the next step is, you could be, we're seeing with the pandemic, a lot of people are getting into running their own businesses. They've gotten laid off, or they're tired of
That's a hot topic too.
yeah. I mean, so you can certainly do commercial real estate, meaning you can rent out a place and build your business, right? So now the money you save from owning a building, you can use that to rent out a space for whatever your needs are. I've had clients that have done event planning. We're doing one client is looking at doing a wellness studio, like those vitamin injections, a boutique, so, or even a nail school. So, I mean, why not even, so now imagine the magnitude of your money being even multiplied even further by using the money you saved to now put into a business to make you even more money. Now that's
I just want to say hi. Thanks to Jesse, Bobby, and Mark tuning in and watching. I appreciate your support there to tune in. The Mortgage Doctor with Wendy Lee from Xability, Brian Sewell here. So keep it going here. I like the fact that you're going on entrepreneurship. You're talking about the commercial side of it. Well, you just got to breaking down why first-time home buyers should buy, and you're talking about the investment side of it, which I think is important when you're dealing with building wealth. Continue on that path, and then also maybe just go down that move up buyer as well. Because I think, unless I missed one, I think those are the 3 categories for the most part, right?
You do also have your empty nesters, right? So,
Right.
And that's a cycle of life, guys. And, but the key is this. One thing I wanted to say that just kind of popped off the top of my head, as a first-time home buyer, and you can, if you've owned a home before in the past, but haven't owned a home in 3 years, guys, you can still qualify for first-time home buyer benefits, but make sure you talk to your lender. That helps. If they do that, just help them, have them help you understand what's involved when you do have a program that you're doing where you are taking advantage of down payment assistance, and then doing a program where you're not taking advantage of down payment assistance, right? If you have money saved up in the bank account and that was your initial plan to use to earmark to purchase a property, talk to your lender and talk to Brian and ask them, hey, if I were to, let's go through both scenarios. And I always tell a client, go through both scenarios. And that was my first. I asked 3 questions, main questions with a prospective buyer. What is your credit score? A couple more questions.
What's your Credit Karma though? Not on Credit Karma.
What'd you say?
Not on Credit Karma.
What'd you say, Brian?
Not on Credit Karma.
No, not on Credit Karma. Yes, no, not on Credit Karma. But what's your credit score? And I do ask, what website are you pulling it from? What is your income? How much student loans do you have? What's your car note payment? Do you have an income-based repayment plan if you are using, if you have student loan debt? But the ultimate question, the last one that makes that just really sets the pace for me is how much money do you have saved up, right? Because that's going to help me determine which potential lender that may fit for that buyer. Okay. Are you looking to do a 203K, meaning that you're buying a house that you can update and customize yourself and design it yourself? So then some lenders can't do that. But ultimately, the question is, what's your credit score and how much do you have saved up? If you have money saved up, it may make sense for you to not leverage the down payment assistance money because the interest rates are higher, right, Brian?
Yeah, in a lot of cases. Some cases they're not. In most cases they're higher. I was like, oh, what's that? I found that if the loan amount is smaller, it might make sense to do a first-time buyer program because they have a limit on the caps that they can hit you with your loan size and credit score. So there are certain cases where the rate is more advantageous to go that route. But again, that's by not putting people in a box and looking at all their options, like you mentioned. One other thing that you mentioned, and we can get to it, you talk student loans and we talk cavers. I think we got to get to that because that seems to be with credit repair and all that stuff seems to be a hot topic that keeps coming up like every other week. But it's something you mentioned, and I feel like this story has come up in the last, say, week and a half, 2 weeks, probably about 5 or 6 times. That's what, look, people always say, hey, do videos. Like our clients gives us a lot of information, a lot of material. But I had a client that we talked to today about income. You were talking about, you asked them about their income. We can go a lot of places. We can go self-employed income, right? Or we can go what you show at self-employed, but some people don't show all their income. There's people that don't claim their income. So it's more so what you make, what you really make, to report to the government. And that, and I get it. Like when you're talking about really quick, how to qualify someone in debt ratio. I was talking to a couple today, and the couple told me that they talked to another lender about a year ago, and they had a really high debt ratio. And he said, man, I got rid of almost $100,000 in car loans. And I'm like, okay, well, this debt ratio is going to be low. Well, the issue was that I think the wife made like $2,400 and he made $900 in Social Security, right? So not a lot of income, but they wanted to buy a house for about close to $200. So just simple math, guys. If you make $3,000 a month, 50% of your income is $1,500 a month. So let's say a 50% debt ratio. So and this couple, they were just like, man, I got rid of all this debt. Well, I said, is there income you're not telling me about? Oh yeah, I got a self-employed income. I don't file that on tax returns. I got some income. I make, $30,000, $40,000 a year. So they're seeing that, because I'm trying to figure out with the rent that they're paying, how are you living? Because I do the math, Uncle Sam takes some percentage off. So I'm like 3,000, and half of that is 1,500, but your bills are 2. So, so that's how we figure out debt to income ratio. Don't just let us as a lender tell you that. Use the simple math, divide your debt by the total bills that you have, the debt by your income, sorry. And that'll kind of give you an idea of how to properly qualify yourself. And then we can go over that. And, so I think it's important that if you do make more, whether it's Uber, Lyft, I don't know what's going on with that right now with COVID, but that's extra income, but you got to actually properly file that on your tax return.
You have to file it. You got it. And if the IRS don't know about it, then unfortunately the lenders can't use it, guys. And that's the one thing that,
unless we're doing a bank statement program, which is fun.
Yeah, that's something you can definitely do, right? But one of the things I was going to get ready to say, of course, that thought went through my head and went straight out the other end. What was I getting ready to say? Oh, guys, be upfront and honest with your lender and your realtor, your team. We are your advocates, okay? We're not here to make any judgments on anything you do or don't do. But the one thing I will say this, there's, doing this for 20 years, right? There are people who feel that they don't have to share XYZ things to us. But what happens if you don't share that information that you think, if you purposely kept it from your lender or your realtor for a reason, they're going to let me tell you this, they'll find out, right? Because they'll find out, and don't let it be that they'll find out in the middle of a transaction where now you spent money on an inspection, you spent money on an appraisal, and they'll find out in the midst of the process that, whatever the case may be, like what, last year was a big issue with people who were taking SBA loans and PPP loans, and they were using it for down payment rent money, right? That's not the purpose of that money. And so now, you're thinking that you're going to use that money for a down payment, and whichever people there were that did do that, lenders were going back and looking at like, okay, well, what's this large deposit, right? So ultimately, you guys have to just make sure that if there is something that's questionable that you want to just ask the lender or tell the lender, right? Because again, we're free. We just want to be able to know so that we don't waste anybody's time. And then if anything, it hurts you because now you think that you're going to be buying this house and you might not be able to.
Yeah, I mean, just be transparent. I mean, I know we say less is best sometimes, but if there's something that, and on the new applications, honestly, it's one of the reasons why we do a lot of them over the phone, but it's why one of the reasons I like to get the apps done online, because you can fill it out completely, and then I can ask questions. But you can go through those questions, and so it's better that you be transparent. Another thing, Wendy, that we see a lot is when you go through these credit repair companies and they're encouraging you to delete student loans. Have you seen that?
Oh yeah. Yep. Yeah, we've had those, right?
Yeah. So one of the things that we've been doing is pulling the cavers up front when we see a loan and it looks like in default, we pull all that stuff. But what cavers are, guys, if you don't pay student loans, and Wendy mentioned SBA loans, if you don't pay either one of those, you may not be able to get an FHA loan. Now you might be able to get a conventional loan if your credit's really good. But you're probably going to have to settle that account, and not to talk lender jargon, because I know I get into doing that. What a caver's lien is that basically you have an outstanding debt, either with on a previous FHA loan you might have had, a student loan, or an SBA loan, and you got to resolve that issue before you can buy a home. So you go into someone to tell you delete, 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 and they delete it so much, they dispute it so much that it gets off. You're still gonna be responsible, and we're gonna catch it. You know, when we pull the cables, and we pull those up front, especially now. You burn me once, that's it. So that's, you know, it's important that we're transparent about that and we figure it out. And if it's something that's incorrect, you dispute it. But if you know you owe, I'm old fashioned, man. Pay those you owe. You know, figure it out. If you got to file bankruptcy because of that, I mean, that's understandable too. You know, so there's things you can do after bankruptcy to buy, but just, you know, we don't judge you for that. You know, it's just make sure that I say be upfront with your lender, so their job is to help you get a home, man. Whether you're using me or someone else, they want to help you out. And when we have to play Inspector Gadget, which is part of our job, which don't get me started on this, Wendy, I'm gonna leave that alone. But part of our job is to catch things and all that stuff. And so, you know, we want to build a relationship. We want the situation, transaction to be smooth, but also we need to make sure that we're aware of everything that could potentially not rescue a deal. And we'll have an announcement before the end of the show, which Wendy's gonna like. That you asked something you asked me to do, and I actually I'm going forth for doing that as of February with all loans, all pre-approvals. Right. So you know what it is, don't you?
I think so.
Yep. So the hell out. Yep. But no. So I mean, I think that we covered that. We covered the cavers. We covered student loans. Wendy, I want you to talk about investment. Do you want to talk credit for a few minutes? I mean, is that you think that's still a big challenge? We kind of talked about it a little bit with cavers.
You know, I think that credit is certainly a point of discussion that a lot of people need to understand, right? And I think that there is more than just the fact that it's about a high credit score, because, you know, 620 could mean three different people could have 620, but it could mean three different outcomes, right? And it depends on what's on your credit report. And someone asked me this question the other day, and I kind of like, well, I don't know. And I had to go and verify. But ultimately, you know, once you get into that range, when this person says they have a 690 credit score, but they were working towards getting at least 700, 720, is that going to make a big difference in their credit score? I mean, on their interest rate, if they're 690 versus 720?
Yeah, it will. I mean, it crazy might sound. Fannie has these different hits. So if you're under 740, there's a hit. It's called risk-based pricing. FHA has joined the party with that too. That's why they've lowered their credit criteria. You can go down. We go down to 580. Actually, FHA allows you to go down to 520. That's a broker deal. I don't want to get involved with that. But it's just in general. So there's hits based on the risk level. So if you're at a 720, your rate might be, and I'm making this up, say 3.5, right? If you're at or 3.375, if you're at 720, your rate might be 3.625. Or it might cost you more money to get the same rate. It might cost you, $800, $1,000 to get that same rate. So making sure your credit score at 740 and above, you're great. Actually, when you're above like 760, they start giving you credits too, because they like the loan. You know, it's like, oh, this is low risk. They like it. So that's why it's called risk-based pricing, and they implemented that years ago. Fannie Freddie, you know, so to cover their risk. But FHA's got involved with that as well.
So now also on the flip side, guys, right, when you're dealing with 690 versus 720 or 760 credit score, and you know, you see lenders that talk about and you know, talk to me about your feelings and opinions about this, Brian. I mean, I see some lenders naturally like they're going to push, hey, we can go down to 550 credit score. The question is, at that point, 550, 580, is it in the interest of the client to really try to get into that type of loan, right? Because it's risky to yourself at the end of the day, right? So if you're at 580, 550 for a reason, so as long as you know that you know, hey, you understand what happened and you got a control over it, that's great. But it's going to cost you more money to take on that loan that's 550 or 580 credit score. So if that's the case, if it costs you more money, maybe you need to take the approach of just taking 6 months off. You know, it could be even as fast as 3 months, right? That you can just work on getting those scores up to at least the 620 so that you can get a better interest rate. Would you agree, Brian?
Yeah, so I agree, but I actually kind of changed my opinion a little bit on this, and here's why. Let's say you have an instance where if they're living at home with family, and you know, that's different. But if you're going to go out and pay I don't know, 1,500, $2,000 a month in rent, you're signing a year or 2 year lease, and you as long as your mindset is I'm going to work on my credit, you're paying a higher rate, but it depends on how big of a difference is the rent payment, right? Because I still think buying a home is how you build wealth. It's how you but you have to go into plan. We talk about living off 70% of your income or 80%, just to make sure that you're able to save and also be able to move forward. And you're going to be paying somebody's mortgage anyway, if you're in that case. Now, if you're living at home with family, then I would recommend stay as long as you can and stack, right? Until now, don't be 40 years old, staying at home and stacking because you're still throwing money away. So let's clarify that. But I mean, just stay there so you can be comfortable and you can go into it and buy your home and build wealth. So I'm going to say predatory lending. I don't want to use that, but you are paying more. You might be paying a point and a half more depending on your credit score, and having to do things where you could probably potentially, like Wendy said, take a couple of months and work on your credit. I don't think you should go into a bad loan, but each situation is different. You could be coming from a divorce and you don't want to go pay rent. You want to move in right away. You could be in a situation where, the rents are really high and it's cheaper for you to buy, even at the higher rate. So it just depends. So I'm not totally against that. Wendy knows me for years. I would say work on your credit, fix it. But with these rates being all time low, even if I end up giving you a 4.5 rate or a 4.25 rate, that's still better than you paying somebody else $1,600 or $2,000 a month. So but work on your credit and come back to me in 6 months and refinance. Okay, like
that's true, right? You can do. I mean, there's more than one way to skin a cat, guys, and that's the whole point. We're having. I'm intentional with my banter and conversation, so that it causes you to really think about it. The intent is to put a seed in your head and put a thought in your head and be like, okay, now is that resonating with you? If it's resonating with you, reach out to us. We're here to, again, no judgment. We're here to just have a conversation with you to help you get past the situation and how to get to the goal that you're looking to achieve, right? So, I've got clients that have bought with 580 credit score. I'm not saying I don't support it, but there are lenders out there who encourage people to really think about before you go on a mortgage with a 580 credit score, you might want to reconsider it. And so I just wanted to ask, and again, put this out there so people can kind of think about it. And I know, like, at least with me, like when I hear something on the radio and it's something that, and you may not hear everything as you're listening and driving in the car, right? But you will hear it when it tunes in, and you'll tune into it because it resonates with you, right? And so the key is to let it kind of sit there and marinate and simmer in your head and be like, hey, you know what? Let me ask a question. How can I make this better, right? So, what else?
You definitely pay more on closing costs, though. I mean, the points are between you're not, this is not just a regular 3.5% down. You're going to be paying some points, and you're going to be taking a much higher rate.
Correct, and closing costs too. That's another point that another discussion that we have to talk about, right? Because right now in this marketplace, it's just unfortunate because FHA is, conventional is not king in the sense that they're the only ones that get offered. Their offers are the ones that get accepted, because Brian and we closed the deal with a client just recently and they were FHA, right? So it's just how you are, how intentional are you in terms of how your plan of action, right? How I have a specific plan of action and how I have helped in the last 2 years successfully with clients that I didn't have to be. I'm not one of those agents, knock on wood. I don't want to bring this into 2020 because I don't want more offers, right? Well, not more offers of the same client, but more offers. Okay. Yeah. But in the last 2 years, I've been very successful with my approach in how I help clients buy a home. Are you really having to go to FHA? But ultimately, if you have to go to FHA, there's a different way you can kind of run through that process so that it becomes less overwhelming and less painful, because it hurts me to hear or see that a client put an offer on a place and it could be 20, 30,000 over what the property's price is, but they still didn't get accepted, right? So how can you plan to at least help your client win the deal? Because I go in to win. I'm not going to try to go in, and my job is not to go in and submit 20 different offers for the client. My job is to submit maybe 1 or 2, 2 or 3 at the max, but the goal is hopefully the first offer that they put in is the one that gets accepted. right?
Good.
Having been in the market for as long as I have, so I have a lot of relationships with different agents, right? And a lot of times that helps too, right? Working with an agent that you know in the industry, and when they know you're about your business, not saying again taken away from any other agents, right? But a lot of agents who know me, they know about I'm about my business, right? And so they're gonna bring. They know that if Wendy's client is the Wendy's coming with a client, they know that Wendy's client is pre-approved and truly approved. And of course, we can't. I'm not Cleo. I can't forecast the future, but it's gonna be up to you, right? I had a client who this was a couple years ago. They were approved, ready to go, but during the process, it was discovered the client took not one but two payday loans out to pay for things that they said that, oh, well, you told me not to use my money to buy XYZ, or well, I had to get money out. So well, now when you do a payday
That
loan,
doesn't look good. Yeah.
that's another line of credit that you just extended on yourself, right? So you've increased your debt to income ratio, which a lot of people just don't realize and understand. But this is what we're here to do, to tell you these things so that, again, oh, let me make sure that I don't do this or share this with somebody else. I talk about a lot of experiences in my client conversations or my buyers workshops. I share specific examples, and so that people understand that this is not something you want to repeat, right? Because
Right.
that's
good education. Those, and just taking out loans for your down payment, so like that. You just got to be transparent, with your lender. And while you were talking, and I'm here, Brian Sewell, Cherry Creek Mortgage, Wendy Lee from Next Realty, is that while you were talking, I was thinking about like even this different change with the inflationary thing, where they're talking about preventing inflation and raising rates a little bit. If you got pre-approved, we kind of touched based on this, and I want to come back in November, December. You should probably talk to your loan officer, talk to your lender, and make sure you're still at the right amount and that you still qualify at that amount, because that rate that was probably 2.875 might be 3.3 or 3.5, or maybe a little higher depending on your credit score. So that's something that you really need to look at to see if to make sure you're still good when you're doing your pre-approval. So that's something like do a check-in with your lender.
Yeah. I mean, a lot, unfortunately that is the case, guys, that you definitely want to talk to your lender about that, because, those who have really went through months, or, I've heard horror stories about, oh, somebody's been looking for 9 months to a year. Your pre-approval is outdated now. You've got to update that pre-approval, and don't let that be something that had creeped up in the midst of you looking for a home and something happened and you didn't realize it. So make sure you get your pre-approval updated every 3 months. Is it 3 months, right?
4 months, actually.
Okay,
So
the
credit report is good for 4 months. So you got to make sure that you are you close within 120 days.
Okay. And
guys,
these are things
don't buy anything while you're in the process of buying a house.
And that's exactly what I was getting ready to say. We're going to talk about the 10 commandments, right? Don't change your job. Don't change bank accounts. What else is there? Don't co-sign for anybody. Don't buy any furniture.
Where are my 10 commandments at?
What'd you say?
I said, where's my 10 commandments at? I don't have them in front of me. I can pull them up. Yeah.
And I get to a point where it was funny, as we were rebounding back from the recession of 2008, I was joking around with a lender that I worked with. Well, I still work with him occasionally. But this was way some time ago, right? And it got to a point, I joked around like we had the 10 commandments. It got to be a point where it was 20 commandments, right? Because it was like, thou shalt not take a payday loan out. Because back then people didn't do payday loans, right? Now there's payday loans, a lot of payday loans everywhere.
I'm gonna share this on my screen just for the fun of it. I have it. This is from 2016. Just for some fun here. Hey, Franklin, can I share it real quick? Share screen. Oh, you gave me some power. Let's see where it's at. Where did it go? Okay, share screen. It's saying it's letting me, but I don't see anything. There we go. Here, can you see that, Wendy?
I don't see anything.
This is old school right here. 10 commandments. What do it?
Oh, yeah.
Not change jobs or become self-employed. We can have some fun with this. And what that means, guys, Wendy mentioned that we were talking about being self-employed and going on. Look, this is talking about the process of buying a home. Because if you go from, a W-2 employee, you've been a truck driver, to all of a sudden you go on your own, you're gonna have to wait 2 years to file your taxes, because they want to see how you're gonna file your taxes. Thou shalt not. Can you read? Can you see that? When you got on some. Thou shalt not buy a car, truck, or van unless you
Yep.
plan to live in it. Extra debt. Talk to your lender. Now, we've had situations where somebody got into a car accident. Obviously, credit was good. We didn't care. But, talk to your lender about this. I don't know if you can read those. Can you see them?
Yeah, I can see them. Mm-hmm. Thou
We
shalt not
did
spend the money you have saved for down payment. And that's exactly what happened to a client towards the end of the year. It wasn't a client. I was representing the seller. And unfortunately, the buyer had to use some of the down payment that was saved for the purpose of buying a home. And because they were short on funds, they were not able to close on the deal. So, you have to have the money. Make sure that the money that you ask in advance, your lender, find out how much money you're going to need. If this is what my pre-approval is, and this is how much my house I'm shooting for to buy, ask that question of your lender, how much closing cost, how much I will need, what they call cash to close. So at the closing, prior to the closing, how much am I going to have to bring to the closing table, right? So understand that number so that on the back of your head, that's what you're working towards. Because if you don't know it, and then now you're coming in a week before closing or even 3 days before closing, and you find out, oh, I need XYZ number, and you're $5,000 or $3,000 short, you're short. So how are you going to come up with the difference, right? Yep. So that's again, these are questions that you want to, again, educate, empower yourself so that you know how to move forward fluidly in a process instead of being roadblocks, right? But this is what we're here for, to help you understand the process. But the more you know, the more you will grow, and the more you, what do they call, the more you learn, the more you earn, right? So all these things are things that are here. They're cliche, but they're here.
Rhymes going on. You got a little poetry going on there. Your little church thing going on.
I don't hear nothing. That must be Franklin.
Lord, I'm talking about, you was rhyming. The more you know, the more. I'm like,
it just happened to have that
in the background, like,
I also, there's sometimes you have to have that little corniness to kind of keep it wit, or not corny, but I like to call it wit, right? A little wit helps people laughing, right? So anyways, so we talked about first-time home buyers stepping, moving up. People who are like you, Brian, just talked about stepping up, right? Move up buyers. So you have a house that you're selling, and how do you transition that time, right? So from selling your house to buying a new house, there's that kind of fine science that comes behind that. And what we're finding a lot of people are doing these days are they're finding, because they know that their house is in an attractive area. If your house is an attractive area and you are, you priced right, you've got great finishes, or even if it's a house that needs some fixing up, right? What I'm seeing that a lot of clients are doing, a lot of sellers are doing, is that they are going under contract with their house first, their purchase, before they put their house on the market. Because it's no great feeling when you're like, oh my God, where am I going to be living? Where are my kids and I, or my significant other, whatever, where is my family living, or where am I going to be living, right? So what we're finding is a lot of sellers are putting their house on the market after the fact. Like I was referred to to somebody today. They're under contract to buy something, and now they're ready to sell their house. So I'm coming into the picture to help them with the sale of their home, right? So make sure that that's also timed right, because as long as, and this is something that you want to ask your realtor, it's like, well, how much time, what is the turnaround time in the area you're trying to sell your home in, right? There are some areas that are naturally more more desirable than others, because it may be school district, right? Because Homer Flossmoor School District, people are lining out the doors. There is so little inventory that people are spending months and months and months trying to find the house because they must live in that school district, right? So ask that question of your realtor, what's the average market time for some of these homes. And having to work with a realtor who knows a lot of realtors, other realtors, is also can help you. And this is how I helped 2 or 3 of my clients last year buy a home. Helped them buy. I knew of a product that was hitting the market very soon, and I brought a buyer that was well bona fide buyer to the seller's agent, and our offers got accepted before it even hit the market. So what they call sold before print is what you see on the MLS, right? So these are things that you have to, be ahead of the game. What do they call it? My guy says, play chess, not checkers. So learn how to, think ahead of the game. Be very strategic.
No, I like that. When you talk about move up buyers, this is kind of time, and thank you, Wendy, so much for sharing that. When we're talking about move up buyer, when we're talking about first time buyers, I'm going to show this little screen here because I think we can tie this in to show, like, sometimes people will say, man, I want my dream house, but the first time they can't do that. Well, if you do this, then the second time is going to be a lot easier, right? Because you're going to have equity. And I always like to see if I can show that. But what area do you want me to hit, Wendy, before I share the screen really quick?
I'm sorry, what was it again?
What area do you want me to target, just for example, before I share the screen? Like, do you want to
Burr
do
Ridge?
Burr Ridge? Okay. You're going to be millions. All right, hold on.
Well, okay, let's go more. Let's talk about Homewood Flossmoor, right? So
yeah. You said Berwyn. I was like, yeah. Well, they're like, yeah.
Berwyn is good too.
Did you say Berwyn?
Berwyn.
Oh, I thought you said Burr Ridge.
I did say Burr Ridge, but I said, well, Berwyn could be more realistic, right?
We can hit them all. Why not? Here. All right, give me I'm going to share the screen. Okay, I don't know if you can see that. All right, give me a purchase price. What we thinking, like $350?
Mm-hmm.
I did. I hit it. Of course, it wants to act up. I don't want to do Indiana. All right, let's look at this. So look, and I know it's small, but guys, like the average rent in this area is like $2,150. So Moody Analytics puts this in there, and so it's telling you if you buy a house for $350, it's got your taxes, it's got your, and I'm going to take my time and go through your taxes. It's got homeowners insurance. It's got the cost of repairs. It's got you selling that house and selling for 6%. Basically, what they're expecting the value to be in 9 years is 503. And this is Moody Analytics. And we go show results. This is how you build wealth. So in this case, appreciation is $153,000. Okay, your cash flow difference is $59,000 compared to you paying rent. And then your amortization, that's the principal you paid down, that's about $64,000. You take these three things compared to paying rent, that's $240,000. That even after you sell your home and closing costs and realtor costs and cost to sell, you're walking away with your net gain is $250,000. I'm sorry, $240,000 in 9 years. Mm-hmm. So now when you turn around and say, hey, I want to buy a house for $650 or $600. Well, now I got $240 in 9 years to put down. And my net worth is higher.
Yep.
So this just kind of give you an idea how this works. And it's Moody Analytics, but I love showing people this because you can see kind of what the plan is. And again, and this is, they're using, as far as amortization is concerned, they're using what they're anticipating, but we're looking at like on average 3.4% in rental increase, but the appreciation, I believe, is like 4.5%. Let me just pull that up. Yeah, forecast appreciation is 4.12%. So
now let's kind of compare this. The renting was $2,150. So what's the mortgage approximately payment of $350? And let's say the taxes are $7,500 a month. I mean a year.
I mean the total monthly with taxes and all that stuff is $1,931.
So there you go. There you go, guys. Renting was $2,150, but it was $1,931 to purchase. So you're saving $250 right there, guys. Right. $250 can be, your playing money, right? And now that could be a trip, right? That
those taxes are probably going to be a little higher. You know what I mean? So like if we say the taxes are high, even that what you're saying there, the cash flow alone, but then the amortization, that what you're getting there from appreciation. I'm sorry, amortization is over there, but depreciation, then amortization, those two, even if you throw the cash flow away, those two alone is 200 grand. That you look at, and I think conservative, you look at what's happening. I mean, that's, and I'm looking over here, it's right in front of you. But it's, I think that this is a way you build wealth. It's a way to start. And then Wendy talked about all the other stuff, own businesses, put some money up in your retirement. Go ahead, Wendy.
And what the beauty of is that the reality is this, guys. When you own a home, you have the ability to, I do this with a lot of my workshops as well, where think of it this way: when you are paying rent versus paying mortgage, you are taking out of the same checking account, your Chase account, and you're paying $21.50 for rent. But if you purchased, you're taking out of that same Chase account. Oh, sorry. You're taking that $21.50, paying it out of your Chase account and putting it into your landlord's Chase account. Whereas with you buying your house, you're taking that $21.50 out of your Chase account and putting them back into your account, because now you're taking out from the $350,000 mortgage that you have. So after the 30 years, you've bought your house. Whereas after 30 years of renting from not, maybe not per se that specific landlord, but let's say 30 years of landlords, you have just bought a fraction of each landlord's home when you could have bought your own home at the end of the day.
I love that. And we're playing a little Monopoly here, Wendy. You turn around, you sell that house for 500 some thousand, what it's worth. You turn around and put a couple $100,000 down, right? Yep. So now you got $280,000 in appreciation. I mean, this is a $550,000 house. Amortization going that you paid down in 9 years. You just net gained $442,000. You took your $200,000 and doubled it. Yes. Now again, this is a move up, but this is another way of building your net worth up. Now you got 400 some thousand in that area. So this is it just gives you an idea, guys, how to build wealth. And we all know it. I think most of us played Monopoly growing up. I'm not going to say I was good at it, but although I used to play cash flow, now that was fun. It's similar. Anything else you want to add to this? I'm going to stop sharing the screen, but just
No, that's good. That's good. I mean, these are bullet points and main points that we want to talk about it today, and just continue to drive the message home for people to understand that there's a lot of benefit that goes behind it. Of course, there's everything, there's good, there's some bad, right? So now you've got to pay for the repairs, right? So now you just can't pick up the phone and call your landlord, because by the way, you are the landlord, right? But at the end of the day, still repairs and improvements to your home, some of them are tax deductible, right? And so then again, it's another way you can make more money coming back to you at tax time, because now you own a home. If you rented that house, you can't do that. So, I have a friend who, she's probably in her 60s, right? So the only time she owned a home was when she was married. And so other than that, she's been renting, let's just say that she's been renting, let's just say 35 years. That's a lot of money that went towards rent, right? So but again, it's to each their own. I'm not here to knock it, but I'm just kind of giving the reality, and the facts are that at the end of the day, after 35 years, 40 years of rent payment, just kind of added up. How much did you pay somebody? Yeah. You can't show for it at the end of the day, right?
That's a lot. That's a tough situation to be in, and you're like you said, you're throwing a lot of money away, and you're not building wealth. And that's what the game is all about, guys. It's if we could help one person. We had some people jump in and out. I know we got people on WVTC app. I'm on there. But we're going to be consistent with this. We'll have some market. We're going to start doing some giveaways and things like that as well. But if we can make a difference in one person's life, and whether you start a business or you want to get in our industry, whether you want to become a homeowner, you can talk to either one of us. We'll be happy to share that information. Somebody had to help us out along the way. Wendy, what's the best way to reach you? And I'm grateful for you coming on the show, Wendy. Sorry, I forgot to give you.
I'm happy that we're doing this every month. This is going to be cool. So you guys can get a hold of me through either my phone or call me, text me, 847-420-5923, or you can reach me through my social media platforms. As Brian had indicated earlier in the conversation, I am very present and relevant on Facebook, as well as the other social media platforms. And you can find me at Facebook and Legacy Realty Group. So LEEGACY Realty Group is my handle. And I'm on Instagram, Facebook, LinkedIn. I have a YouTube channel. Follow me weekly on Wednesdays where I do a lot of wisdom wealth segments. I'm 8 a.m. on Wednesdays. I do a wisdom wealth segment and just kind of the topic of the mind that comes of the week, right? That something that experience that I had shared with a client or something, and I want to share with other people, or a different product or whatever the case is. I'm on there every Wednesday at 8 o'clock in the morning.
Great, man. That's awesome. And so you got a way to get a hold of Wendy. Hey guys, if you're thinking about buying or selling or refinance, look, we'd love to help you out. Give us a shot here with Cherry Creek Mortgage. We'll take our time and treat you like family. Our 4 promises: close on time, no surprises at closing, treat you like family, and we're going to communicate with you. So I think that's important. Please give us an opportunity.
Very
to help.
key.
Yeah, very. And we bring a lot of value to that. You can reach me at 630-352-0629, 630-352-0629, or mytrustedprovider.com. That's mytrustedprovider.com. Wendy, great show. Thanks for doing this with me. And we're going to do this every month. We're going to be giving some things away and getting this thing marketed and being here to help educate everyone. So you guys have a blessed weekend. Tomorrow's Friday. Enjoy your Friday and then have a blessed weekend. God bless.
All right. Take care. Bye-bye. Thanks, Brian. Bye-bye. Thanks, Franklin.
Thanks, Franklin.
Bye, Brian.
Views made on the preceding program are not those of WVTC Radio, iNetworks Communications, or their financial supporters.
Winning victory through Christ. WVTC Allsip Chicago.